At the minute, doesn't it feel like absolutely everyone is saying there's going to be a crash soon?
We will have a crash.
Crash could drag down the global economy.
These predictions get a lot of attention because, let's just admit it, right? We love it. We love predictions. Whether it's a groundhog or an octopus predicting a sporting event, to ancient soothsayers or oracles predicting the outcomes of wars or the weather. Or there's today, where we don't pin our hopes for a bountiful harvest on the backs of gods, we place the performance of our portfolios in the palms of people peddling predictions at a prodigious scale. Today, I just want to stop and ask what I think is a sensible question. Are any of these predictions actually worth listening to?
Or are we in an AI bubble? Of course.
The most comprehensive study I could find tracked 6,582 forecasts by 68 different market experts between 2005 and 2012. They weren't amateurs, they were professionals with significant followings. 41 of these 68 gurus scored below 50%. The average score was 46.9%. So a coin toss beat most of these experts. The best overall was David Nasser at 68.2%. Sounds respectable, right? But after the transaction costs required to keep up with the tips that these guys were giving you, the study found that none of them would have made you any money. What's mad to me, right, is I can only really find one study on this. Maybe there's others that exist, they're just not as prominent, I don't know. But you would think in a world where the rewards of identifying people who were good at making these predictions, they're really high, right? If you can find someone who can make accurate predictions, you can make billions off those predictions. You think we would keep score of these market mystic megs more closely, right? Why doesn't CNBC show a percentage next to their talking heads every time they're on TV of how good their predictions are? Probably because if they did, it would become very clear very quickly that their track records are patchy at best. But looking at this list, while these guys might be prominent in the industry, they're not exactly household names, are they? So let's broaden this, shall we, by looking at some big guns. I've got some tarot cards here that I'm going to use in this for dramatic effect. I love a theme and all that, and it's kind of in keeping with our whole prediction thing, isn't it? Funny thing, I ordered these off Amazon and I forgot to put my name on it. So for some reason it pre-populated my missus's name, and she was genuinely convinced when these turned up and she just opened this random envelope addressed to her with tarot cards in that someone was trying to place a curse on her. Wait till she gets the Ouija board. Today, we're going to start here. Michael Burry is a star investor because he famously predicted the 2008 financial crisis. He became a household name due to Christian Bale's portrayal of him in The Big Short. Just go onto YouTube, type Michael Burry, and you have countless videos analysing what he's up to and the predictions that he's making. The fact that people use Christian Bale's image in the thumbnails and not Michael's actual photo kind of shows how ridiculous this all is. It speaks to a wider issue you have when it comes to listening to predictions. You can find lots of claims that since 2008, Michael has predicted a crash every single year and that he's always been proven wrong. But there's potential for prediction misinformation here. A challenge for people following his predictions is working out whether he actually said there would be a crash every year, or whether Burry's Big Short reputation is being twisted for a sensational headline. Burry says that he's worried about index funds. That becomes him predicting a passive investment bubble. How many people then read this headline and panic? On X, Burry fashions himself by the name Cassandra, the Trojan princess who was cursed by Apollo to have her true prophecies ignored. So clearly this is a man who thinks that he should be listened to. But in 2023, he apologised through gritted teeth to the investing community, saying he was wrong to tell them to sell. I actually think the problem here is that the finance world and investing community spends way too much time talking about what Burry says and does, based on a mythology not established by the Greeks, but by a pretty good movie. Okay, next we have the Emperor. Jamie Dimon is arguably the most powerful man in world finance. As CEO of JP Morgan Chase, he is the ultimate insider. He has the finance world in the palm of his hand. Yet there is a meme about Jamie that he has predicted 22 of the last 3 crashes. Here's a list of some of his calls on screen. His latest is a prediction for 2026, so maybe that one lands. Okay, next up is my favourite. Jim Cramer is a former hedge fund manager, but today he's known for his long-running CNBC show. And this man rattles out predictions at an industrial scale.
So I went and bought more. I went and bought more right there. Well, could I have been more wrong? I don't think so.
In 2021 alone, he made 725 buy and sell recommendations to his viewers. There is varying levels of analysis on his performance and how good that these recommendations are. But when he's firing out buy and sell recommendations at a rate of 1 every couple of hours, How can anyone keep up with all the analysis required to manage all of that? But that's the thing about Jim. He's no longer in the business of generating returns. He's in the show business. Jim is the stock market jester, paid to perform to make predictions for his audience. And that's an important point, really. We need to question, why are these guys doing this? What are the incentives of the media and these predictors to make all of these claims all of the time? CNBC is on 24 hours a day. TV channels want people to say things because it gives them something to fill the time with. So what about the predictors? Isn't it weird that a man in charge of a bank who has an active interest in getting people to invest their money with them is constantly so negative about the outlook for investors?
And you're not worried about a recession in 2026 for the US, you made that clear.
I think it could happen in 2026.
He's a smart guy, right? I mean, he is no fool. So what are his motivations? If we're honest with ourselves, it's probably not to help you all the time. They're most likely these predictors trying to help themselves by either attracting clients, talking up or down their own investment book so that they can make money, or maybe just because they like to hear the sound of their own voice. Predictors predict not out of the goodness of their own heart because it directly benefits them. There also is, or what appears to be, an asymmetrical risk to them. These predictors can become wildly famous for a single prediction, yet remain pretty unpunished for a series of bad calls. So they might as well make loads of predictions then. Now, not everybody has a patchy track record, of course. There are a handful of people whose predictions have been spot on. The best example I can think of is probably Jim Simons. He created a fund that between 1988 and 2018 delivered a return of 2,103,217%. The S&P 500 over the same time period returned 914%. This man made 100% in the dot-com bubble, 83% in the financial crisis. He was famously private, he did not discuss the workings of his own fund. For all intents and purposes, he was a hermit. Now you could use Jim or a couple of others as an example to disprove my broad belief that people can't figure out the market. But people like Simons are exceptions, they are not the rule. So the chances of you being him are slim. I mean, if you are Jim, crack on, go and do what Jim did.
I did a lot of math. I made a lot of money, and I gave almost all of it away.
He invented a money-making machine, then locked that thing away and let it run. I think we should be highly skeptical of anyone who says they know what is going to happen in the stock market and then gives that information away, which is worth hundreds of billions of dollars for free. If you're a business owner trying to make your own money-making machine and you don't want it to cost you hundreds of billions of dollars, well, you should check out today's video sponsor, Odoo. When I set up this channel, I had absolutely no idea what kind of services I would need to run it. Basically, if I had a problem, I would go out, I would do loads of research on what I thought was the best service solution platform, I would sign up, and then there's another subscription that I have forever. And the cost of these would just mount up and up and up. Well, Odoo's a solution to that because it provides an all-in-one place for a low fee. Think of them as a bit like an iPhone, but for business management. They have more than 45 apps to help you manage your whole business, from accounting, project management, even document signing, point of sale, basically everything. A bit like an iPhone with all the preloaded apps on it in a way. All of the apps speak to each other as well, so the integrations between them are seamless. Send an invoice to someone, it automatically registers on your account software, which just helps you automate everything and reduce manual entries. They also solve that problem that I spoke about at the start because they have packages of particular apps that are designed for certain sectors because they have 15 million customers globally, so they understand what different businesses need. So when you sign up, you can say, oh, I'm in this industry, and they go, well, these are the apps that are tailored for you and set up in the way that you need them to run your business. You can get access to all of Odoo's apps for about £20 a month, which is less than a lot of the individual apps I've paid for in the past. If you just want to try Odoo out and see if it's any good, you can get the first app for free forever with unlimited support. You can sign up for that app using the link in the description or just use the QR code that's on screen. Okay, I do want to take a step back for a second, and I want to say, at the minute, with the stock market, with the general global economy, there are clearly concerns. Lots of concerns. I mean, we could just point to the sustainability of the whole AI bit. I don't think that these people are just chatting crap, but I do doubt the ability of lots of people, all of these different predictors, to predict the direction of the market in the short to medium term. And I also doubt how useful it is for individual investors like ourselves to act upon all the predictions that we hear. All of the individuals that I've just covered there are highly intelligent, and their predictions that they present are often compelling, backed up by data, driven by intense research, yet they were still wrong. The problem we have sat at home watching these pundits is, how do we know who is going to be the person who is right? how do we decipher between, a good predictor and a bad predictor? Because even having a track record of a previous prediction that went right is no guarantee that your future ones will be correct. If anything, it's the opposite. Also as well, how do we know that the pundit is sat there based on their merit and not just because they got lucky? Nazim Nicholas Taleb produced a simulation in his book Fooled by Randomness, where basically he created 10,000 fake investment managers, each with a 50% chance of making money or losing money in a single year. Essentially, he was flipping a coin to simulate market performance. After 5 years, purely by chance, 313 managers had made money every single year. If I was to hold those managers up and go, look, these guys figured it out, these are the guys with the market insight, that's really just like me saying that someone who's won the lottery is gifted at picking numbers. Warren Buffett is probably an investment genius, but he could also just be the one example we have of a simulation running all of its combinations. He also just so happens to be an example of someone who's built his success not by making market or short-term economic predictions. In environments where there are high amounts of randomness, like the stock market, and there are large sample sizes like all of the investors that participate in the stock market, there will inevitably appear to be successful people due to purely statistical variation or luck. I think the only person who can really claim to have complete power over the market right now is Donald Trump and his inner circle. And yet again, he keeps his antics surprise to everyone apart from those who profit from his social media posts. I know it's tempting to believe that people who work in finance, who speak with conviction about all manner of topics, are somehow in the know. I mean, it's literally embedded in what makes us human. Apophenia is the tendency to see meaningful patterns and connections in unrelated things. Is that cloud in the shape of a dog? Is that Jesus on your toast? Does that line on the chart mean the stock market's about to go up? This was a survival trait, because think about it. The person who could spot the tiger in the grass would survive. I know that that's a lion and not a tiger, but I'm just saying, if these cards were actually good at predicting things, they would know that I needed a tiger and we would have had a tiger there, but yeah. As a species, we often see patterns where there is none. If the past, by bringing us surprises, did not resemble the past previous to it, what I call the past, then why should our future resemble our current past? It's anyone's guess what that means. I think what he's saying is, if people in the past couldn't predict today, then what makes you think people today can predict the future? When the markets are at all-time highs like they are today, and the headlines get gloomy, it can be really tempting to listen to the predictions because they get very loud. But at a point like this, you don't need prophecy, you need a plan. Here's mine. Here's what I do as an investor in times like this. Please understand that this is not investment advice. Don't take investment advice from a guy in his spare bedroom, sat there with tarot cards. But I'm a global index investor. That means I buy the whole world. And I currently invest with a 20 to 30 year time horizon because of my age, but I'll cover what I'll do when I get a little bit older as well. But because I buy the global stock market, I see this one of two ways. So either the prices go up, which they tend to long term, or they always have in the past. Past performance is no guarantee of future results. But let's say over the next few years, the prices go up. I wish I bought more today. Or the prices go down. That means it's cheaper than it is today. And I'm going to buy into that because I understand that after prices drop in the stock market, the expected return increases long term because I'm getting more units of the same thing for a cheaper price. It's on sale, essentially. So actually, at my age, with my kind of investing timeline, I really want the market to crash. I want big dips now so I can buy more units of the market for cheaper. And then, when I get to retirement, I want to avoid those crashes. Now, I can concede that if by some form of miracle or insight, I could sell everything today, wait for a crash and buy at the bottom, I would profit from that. But I understand that that's almost impossible to do. Because if Jamie Dimon, the master of the finance universe, can't predict a crash, then what chance do I stand of doing that? And also, when you time the market in this way, when you try and sell and buy back in, you have to be right twice. You have to hit bullseye twice. You have to sell at the right time, at the top of the market. You have to buy in at the right time. And what you tend to find is people might get one decision right, they might not get two. Now, the only time I would change my view on this consistent buying is when I approach retirement and I need the money, because then I'm sensitive to those declines in the market, as I'm looking to protect the value of my pot, not grow it anymore. So if I'm worried that the stock market might crash, which at some point it will, it's going to happen, how can I limit that impact to me? That isn't a question of timing, it's one of asset allocation. Do I just move some of my holdings out of equities that I fear might crash into less crashy assets to dilute the risk of the stock market dropping? I would apply the same sort of approach if I was a younger investor but I was losing sleep at night over the potential for a market drop. I'll say it again, at some point the stock market is going to drop. This is a feature of investing. So you need to plan for it, not see it as a problem that you try and fix or dodge. You need to get really comfortable with this idea that at some point the stock market will crash. And if you're that worried about a drop that you can't sleep at night, well then your portfolio just doesn't match your risk tolerance and you should address the asset allocation accordingly, almost as if you were an older investor that needed to protect against a crash. Investing isn't about reacting to predictions, it's about managing yourself so when the bad times come, and they always come, you just don't panic and wreck a good long-term plan. This is all about temperance, about managing oneself for the inevitable roller coaster that is the stock market. Remember those soothsayers and oracles that I mentioned at the start? We've always looked for someone, just anyone, to give us certainty over what will happen. It's just that the tools have changed. We've swapped sheep guts for spreadsheets. But we're still just humans, desperately trying to see a future that doesn't want to be seen. So next time you hear someone saying they know what the stock market's going to do, question, are they actually the Messiah? Or are they just a modern day prophet reading the PG tips in a three-piece suit?
Hey, you ain't got a clue, let's be honest. I had a couple seasons made a forest. I put in the work and take the profit.